Today is Sunday, May 28th. The market is closed. So we have a little time to go over some unusual option activity that happened just 30 minutes before the market closed on Friday, May 26th, the last trading day. This all happened on Tyson Foods, ticker symbol TSN. And so in this video, we are going to analyze these unusual options and then show you how we are trading Tyson Foods based on the unusual option activity. So without further ado, let's get right to it. So you'll see here, 3:35 p.m., May 26. These are for the June 16th, 52.5 puts and the 52.5 strike calls. 2,845 contracts. Okay, so just to get an idea of the value or the buying power that was required to do a trade like this, you could see that this was done at the 52.5 strike puts, meaning that they were willing to own 100 shares at $52.50. So for one of these contracts, this was how much was required, $5,250. And by selling this put, this is a cash selling a put. It's a naked put, and so you have to also multiply the number of quantities. And so when you do that, you get $14.9 million. So this is a very large capital required trade that a large institutional investor did. And so what they did was, once they sold this, which is moderately bullish, they then also bought the 52.5 strike calls, equal amount of them. And so when we look at the chain, we can see here the 52 strike, 0.5 strike. Over here, the volume on the put side, much greater than the open interest, so we know these are opening orders. Over here, this is also greater. And you'll also notice that this the amount is also greater than the open interest. Okay, so what they did was they sold this, and then they bought this, the 52.5 calls. And so when you analyze this trade, you get a synthetic bullish call or a synthetic bullish trade. It's a call and a put together as one trade. And you can see as the price of $52 goes up on the x-axis, this will become profitable because this is above the profit loss zero line on the y-axis, and anything below that is a loss, which is anything down here, which is anything below $52. Okay, so when we look at the chart to kind of get an idea of have we bottomed, it does look like there was a bottom right after earnings on May 5th. This was the last day right before earnings, when it dropped about 16% after the earnings reported, and then it went down actually even more. So another 2 days until we hit the bottom at 47. So if you've ever heard of the phrase "don't catch a falling knife," and the 3-day rule is to wait 3 days before you buy something, and this looks like it. If you followed that rule, it would have worked because these 3 down days would have, this third day of that red day would have signaled the bottom, and it looked like it did. So currently, because we are approaching this level, there may be some resistance here, so that is something to keep in mind. However, if we can break through this level, this gap will be very easy to fill, And if we can break that, then it will go up quite strong. But we will have to see if this resistance can be broken. That is the main concern. And based on these unusual options, it looks like it could, but we are going to approach it with some risk mitigation for our trade because of this potential resistance. And so the way we are trading it is a little different. Take a look. We are also getting these 52.5 strikes. However, we're going to sell the 55 strike calls as well. And so what that does is it creates a vertical call spread. It costs a little, definitely a lot less, because we don't have to have that much buying power by selling that naked put. This is our trade. You'll see here it has also a profit if the price of 52 goes up. And so this is all going to be above that zero line here. You'll also notice we did something additional when we go to the put side. Over on the put side, we bought a 47.5 put. You'll see here, this is our position here as well. And when you put that in, they're very cheap. Currently on this market pricing is about $25. And you'll see here, by adding that in, we essentially have a pretty good trade where we're not going to necessarily lose unless we stay in the trade too long and theta decays, because this is the only part of the trade that is below zero is just this this area right now. This is the break-even points now. But even though even then it's quite small, you'll see here it's only about 15. But that's because time hasn't passed as much. Once past starts to go by, it will reach that blue line, and even the blue line isn't as great of a loss, but we will be able to react as soon as possible, because we won't let it get to that point, to that blue line. And the reason why we're doing this 47.5 strike put is because of this bottom here, this $47 line. In case this goes back down and the other direction, we have a hedge that will be profitable if it drops below that $47. If we were to sort of zoom out a little on Tyson, you could see that it's currently hasn't ever really dropped to 47 before. And so in these past 3 years, because it hasn't ever dropped to 47, we're a little concerned that there may be no support down below 47. This is the only kind of the first time it's ever hit 47, made a new low. And so there is a chance that it will create another low, and that this may bounce off that resistance soon, and maybe it would go down. And so we wanted to buy this very cheap hedge that's not very expensive for this overall trade, because if it does go up, as we are predicting, it would still be profitable. You'll see there is still profit to be made. Because what we did was we actually bought, for every vertical call, bullish call we did, we actually bought 3. So we bought 3 of these vertical calls spreads. For every 3 we bought 1 hedge. And so that kind of helps our trade still stay bullish, so we can make maximize profits. And at the same time, hedge our trade in case it starts to drop below this 47 and makes a new low. We would not be at a loss because this will be anything below that 47 will be above that zero line, and so we can still risk this type of trade, this vertical spread here, where we were essentially risking 195. You see here, if you multiply that 65 by 3, but the max profit you'll see here is 555. And so what does that? What is that? Well, that is 555 divided by 195. That's a ratio of 2.84, meaning we're risking 1 to make 2.84, which is something we like. We like trades where we can risk 1 to make more than 2, or 2 is sort of our minimum. We like those kind of trades, because then if you put enough of these types of trades on, you just need to be 50% right and you'll be overall profitable. So that is our trade going in. We have 3 vertical call spreads and then 1 hedge, and that is a ratio we are keeping for this trade, and we will react very quickly as well to see, is this going to break that resistance? It is not going to take long for us to find out, and if it starts to consolidate, we may also change our trade as well. If you do want to follow our updates on trades, we do have a membership that you can join. You can go to our channel and click the join button. We have different levels where you get different access to exclusive videos that we are also making for other stocks that have other types of unusual options activity. And yeah, take a look at that. And please, again, smash that like button if this was something valuable and enjoyed this video. Until then, take care, everybody.